Angola's inflation slows to its lowest level in 3 years, strengthening the outlook for economic diversification. Price growth slows as the non-oil economy expands, improving the investment climate. Although oil and exchange rate risks remain, inflation in Angola continued to ease in June 2026, extending a trend that began in the second half of 2024 and reinforcing signs of growing macroeconomic stability. The sustained moderation in price growth comes at a time when non-oil economic activity is gaining momentum, creating an opportunity to consolidate economic diversification and strengthen the country's productive capacity. According to the National Statistics Institute, INE, the National Consumer Price Index rose by 0.52% in June, bringing cumulative inflation for the first half of the year to 3.42%. On an annual basis, inflation slowed to 10.11%, compared with 19.73% in June 2025 and approximately 31% in the same period of 2024. This represents the lowest year-on-year inflation rate since 2023 and one of the fastest disinflation episodes recorded over the past decade. In just 2 years, annual inflation has fallen by around 21 percentage points, moving back towards single digits. Should the monthly trend observed during the first half of the year continue, Angola could end 2026 with inflation significantly below the 15.7% recorded at the close of 2025. For financial markets, the significance of this development extends well beyond the decline in the headline figure. More predictable inflation reduces macroeconomic uncertainty, improves corporate financial planning, strengthens investor confidence, and creates a more favorable environment for long-term investment, particularly in productive sectors outside the oil industry. A decade shaped by successive adjustments, Angola's inflation trajectory over the past 11 years reflects the country's major economic transformations. After inflation stood at 12.09% in 2015, declining oil revenues, foreign exchange shortages, and a sharp currency depreciation pushed the rate to 41.12% in 2016, the highest level in the recent statistical series. A gradual disinflationary period followed, with inflation falling to 23.67% in 2017, 18.60% in 2018, and 16.90% in 2019, supported by the partial stabilization of macroeconomic conditions. The COVID-19 pandemic and disruptions to global supply chains temporarily reversed that trend. Inflation accelerated again to 25.10% in 2020 and 27.03% in 2021 before declining to 13.86% in 2022, supported by more stable monetary and exchange rate conditions. That relief, however, proved temporary. Inflation climbed again to 20.01% in 2023 and 27.50% in 2024, reaching a recent peak of 31.09% in July 2024. Since then, it has followed an almost uninterrupted downward path, ending 2025 at 15.7% before falling to the current level of 10.11%. Monthly data also confirm a gradual easing of inflationary pressures. After monthly increases above 2.5% during several months of 2024, inflation fell below 1% by the end of 2025 and remained between 0.52% and 0.68% throughout the first half of 2026. This consistent reduction in volatility suggests that the disinflation process has become broader-based and less dependent on temporary factors. The real economy begins to reinforce stability. The slowdown in inflation has coincided with stronger expansion in the non-oil economy. According to INE's national accounts, gross domestic product grew by 5.32% year-on-year in the first quarter of 2026, while the non-oil sector expanded by 6.22%, driven by transport and storage, information and communications, agriculture and fisheries, electricity, water and sanitation. Although lower inflation reflects a combination of factors, including monetary policy, exchange rate stability, international commodity prices, and the normalization of supply chains, the strengthening of productive activity is also likely to be helping reduce some of the structural pressures on prices. Greater domestic production of food, manufactured goods and services tends to reduce reliance on imports while limiting the transmission of exchange rate fluctuations into consumer prices. From a macroeconomic perspective, stronger supply enables the economy to absorb rising demand without generating equivalent increases in prices, supporting a more sustainable disinflation process. Diversification acquires macroeconomic significance. For many years, economic diversification was viewed primarily as a strategy to reduce dependence on oil revenues. Recent developments suggest that it is also becoming an increasingly important pillar of macroeconomic stability. As sectors such as agriculture, agro-industry, manufacturing, logistics, energy, and transport expand their productive capacity, the economy is likely to become less vulnerable to fluctuations in oil markets, exchange rate volatility, and international supply shocks. Recent experiences in African economies such as Kenya and Rwanda demonstrate that stronger domestic production and more efficient logistics networks can contribute to lower inflation volatility over time. While Angola's economic structure differs from those countries, it faces similar challenges related to heavy import dependence and high distribution costs. The consolidation of this transformation will depend on the continuity of economic reforms, greater private investment, improved infrastructure, higher agricultural and industrial productivity, and a business environment capable of fostering competition and innovation. Markets seek predictability. For both domestic and international investors, inflation remains one of the most important indicators of macroeconomic stability. A sustained disinflationary trend tends to reduce risk premiums, improve financing conditions, and enhance the predictability of corporate cash flows. In a more stable price environment, banks can assess credit risk more accurately, companies can plan investments with greater confidence, and long-term projects become more financially viable. Maintaining this trajectory, however, will depend on continued fiscal and monetary discipline, exchange rate stability, and the ability to accelerate real economic growth without generating new macroeconomic imbalances. An opportunity to consolidate a new growth cycle. Despite recent progress, significant challenges remain. The National Consumer Price Index increased from 29.47 points in December 2014 to 264.79 points in June 2026, illustrating the scale of cumulative inflation over the past decade. In practical terms, a basket of goods that cost around 100 kwanzas at the end of 2014 would require approximately 899 kwanzas by June 2026. This reality explains why many households continue to face considerable pressure on the cost of living. Lower inflation does not mean prices are falling. It means they are rising more slowly. Restoring purchasing power will depend on the evolution of real wages, employment, productivity, and the continued expansion of the domestic supply of goods and services. Even so, first half 2026 data point to an encouraging trend. Annual inflation declined steadily throughout the first 6 months of the year, while non-oil economic activity maintained a growth rate above that of the economy as a whole. If this trajectory is supported by sustained investment in agriculture, manufacturing, energy, logistics, and infrastructure, Angola could consolidate a growth model that is less dependent on oil cycles and increasingly driven by the expansion of the real economy. In this context, economic diversification is no longer simply a development objective. It is becoming an increasingly important source of macroeconomic stability, strengthening economic resilience, improving investor confidence, and creating the foundations for more sustainable, competitive, and inclusive growth. The latest indicators suggest that Angola is entering a period of macroeconomic consolidation that is beginning to generate tangible benefits for the real economy. The continued decline in inflation, sustained growth in the non-oil sector, improved public finance sustainability, the relative reduction in the debt burden, and the expansion of overall economic activity indicate that the economic reforms implemented by the government are strengthening the country's economic fundamentals. For Angolans, these developments represent tangible gains that extend well beyond statistical indicators. Lower inflation reduces the erosion of household purchasing power, improves price predictability, and creates a more favorable business environment for investment and job creation. The strengthening of agriculture, transport, telecommunications, manufacturing, and other productive sectors is expanding economic opportunities across the provinces, gradually reducing dependence on oil and enhancing the country's resilience to external shocks. Significant challenges remain, particularly in employment, productivity, household incomes, and the quality of public services. Nevertheless, the simultaneous improvement in the country's key macroeconomic indicators suggests that Angola is beginning to transform financial stability into sustainable economic growth. Continued commitment to economic diversification, productive investment, fiscal discipline and structural reforms will be essential to translate these macroeconomic gains into increasingly visible improvements in citizens' quality of life, while consolidating a more inclusive, competitive, and enduring development cycle.